Good afternoon. My name is Dan Petrell. I'm the Senior Director for Strategic Communications with Maryland Realtors. Today, we are discussing source of income with a very distinguished panel moderated by our Director of Legal Affairs, Kathleen D'Artez, and including Deputy Director of the Maryland Commission on Civil Rights, Cleveland Horton, and Michelle, your Lone Ranger of Mortgages, Michelle Matthews-Kallenach. And joining us later, we are hoping, is appraiser Tom Casper. Source of income, just so you know, is a very important topic. Obviously, it's a protected class, and it is often misunderstood. We learned more about this at our first regional roundtable meeting back in March. And the reason I mention that is that we listen to you folks, and we want to hear what concerns you. So if you have time, there's still time to go to our website and register for our second regional roundtable meeting, April 19th in Frederick, Maryland. With that, we are going to take your questions at the end, put them in the Q&A box that you see, and we will go from there. And with that, Kathleen, the floor and webinar is yours.
All right, terrific. Thank you, Dan. Thank you, Cleveland, Michelle. Tom is going to be joining us as soon as he can get online again. And thank you, everyone who is joining us and watching with us. I will share my screen and pull up, hopefully, the slide deck that everyone can see. Yes, okay. We are, as Dan had just briefly given an introduction, we are talking today about source of income and some guidance that's come out recently from the Real Estate Commission. And of course, Cleveland works with the Maryland Commission on Civil Rights. This is consistent with information that's been provided previously from the Maryland Commission on Civil Rights. And as everyone, I believe, knows by now, source of income is a protected class here in Maryland. Certain jurisdictions had it previously. As of October 2020, across the entire state, source of income is a protected class. And one sort of little nuance to it that may not have been intuitively clear to everyone is that source of income here in Maryland also includes loans, right? The type of financing that a buyer is going to use to purchase the home. So that's going to be our primary focus today. Some people didn't understand that intuitively. Then that raises questions about, well, what if the property condition is such and such? What if, you know, that loan type's going to take longer? There might be more costs. So what we wanted to do today, our goal is to give you practical information for listing agents. If you're talking to a seller, we want you to understand the different loan types to be able to explain to your seller, this is an FHA, here's some features for FHA loan, this is VA. So you can explain the terms, the financial terms, the economic terms to your seller, and they can base their decision on that. We don't want, Cleveland will go into this, we don't want people saying no VA buyers, no FHA buyers. That is illegal. That's discrimination on the basis of source of income. And we don't want people doing that. We don't want anyone having a complaint filed against them. And more importantly, we don't want to deny VA or FHA buyers the opportunity to purchase a home. So let's go through, I'll just go to the next slide. This is our agenda, what we're going to talk about today. We're going to start, Cleveland, I think, is going to kind of give us the overview here of what the Maryland law is. Everybody, I think Dan introduced Cleveland, is working, he's the Deputy Director for the Maryland Commission on Civil Rights, and he does a lot there. He's the guy. He is in charge of the intake folks, the intake division, and the investigation division. So he knows his stuff. So we're going to listen up to what he's going to explain, source of income, and specifically the loan type. Michelle, as a loan officer or loan ranger, is going to go through some details about the processes for VA, FHA, just to give agents information. So when you're explaining offer 1 versus offer 2 versus offer 3 to your seller, you can give a little bit of more detail about the type of loan and some of those nuances. I think, Michelle, maybe we can talk about some of those settlement expenses. Different jurisdictions give a couple $1,000s to help with settlement costs, and sometimes there's some challenges there. Then the next thing we're going to talk about the appraisal process and the minimum property requirements. And look at that, right on cue. Yep. Tom jumps in, your timing is perfect. So I'm going to go through that. And that, again, is important, I think, for listing agents to be able to explain that to their sellers. but also for buyer's agents to understand what the minimum property requirements might be for a particular property. There's geographic footprints for some of these loan programs. So again, just to understand the facts, why a particular loan might be suitable for this property, or why this property may not be a good fit for someone who's going to use, USDA financing, for example. And then we'll go through some best practices. I think hopefully at the end, we'll have a couple extra minutes. I think Cleveland can maybe talk to us a little bit about vouchers, because vouchers is still a problem. Source of income obviously includes vouchers as well. I think, unfortunately, we had to process 3 or 4 complaints just this morning involving vouchers. So we're going to save a little bit of time for that at the end. But let's go ahead and get started. Cleveland, did you want to start just explaining source of income broadly and then specifically with the loan type?
Yeah, sure. So if you want to just move on to the next slide. The first thing I'll say again, on behalf of the Maryland Commission on Civil Rights, it is always, our pleasure to partner with Maryland Realtors. I think me and Kathleen probably talk more often than I do with some of my coworkers. So I do appreciate us having the opportunity to talk about things that we're seeing to make sure that she is taking that back to all of the realtors to make sure that we are making our industry and ensuring compliance within our industry, because that is of the utmost importance. Full transparency, I'm also a licensed realtor, right? So, when we talk about realtors and compliance, it is near and dear to my heart. Every time we get a complaint, I kind of cringe, like, we still got some work to do, right? So, our job at the Maryland Commission really is to enforce Maryland's anti-discrimination laws in the areas of employment, housing, public accommodations, and state contracts. Of course, here today, we're here to talk about, from a fair housing standpoint, source of income, but we do a variety of enforcement efforts throughout the state. In my particular position, I do kind of oversee, as Kathleen indicated, all of our intake and investigative efforts throughout the state. So we go from, north, south, east, west. We cover everything in between, right? So our state of a little over 6 million people, our responsibility is to make sure that everyone's rights are protected as we continue to move forward. We know that we've worked on source of income for a number of years. We were fortunate to be able to get it passed in 2020. I do expect that from a federal standpoint, source of income will also be passed within the next 5 years. I'm going out on a limb and say, I think that source of income will pass within the next 5 years. I also do have the pleasure to sit on the International Association of Official Human Rights Agencies board. And I was in DC all this week, and we were meeting with federal legislators, and source of income has been listed as a top priority to push that through in the near future. So I would anticipate that we all should expect to see that, even from a federal level, that source of income will be federally protected, and you'll see some expansion even within states in terms of what source of income looks like. So, this is our first opportunity to take a look at source of income when it was first rolled out in 2020. But I do expect that there will be some expansions to it as we move forward. Taking a look at the title, I think the title was very fitting, right? Because anytime we talk about source of income, most people think of it as the voucher bill, right? And one of the things that we are always trying to inform everyone is that source of income protection is not just for voucher holders, right? It goes well beyond just individuals who hold vouchers. So as you all can see on the screen, source of income does include income from a lawful profession, occupation, or job. More importantly, and probably what we're going to focus on here today, is any government grant or loan, right? So when we talk about FHA, VA, individuals need to understand that is covered under the source of income statute. So if you're having clients and, during this crazy market, right, and we had 50 showings in one day, right, lines out the door. There were a lot of things on MLS about no FHA, no VA, right? That's when everybody was giving away everything, including their firstborn child, just to try to get a contract, right? But we do want to make sure, though, that we are complying with the law, right? So be very careful about, what you're posting on MLS, what you're saying, because not only are you putting yourself at liability, you're also putting your client, right? So as soon as you put potentially, right, well, I'm sure there'll be some questions about it and some nuances, but as soon as you put up there just the general language around no FHA, no VA, you now are liable for fair housing discrimination as it pertains to source of income. You also bring your broker in, of course, and you also bring your clients in. So we want to make sure that as foot soldiers to the Fair Housing Act, that we are in full compliance. One of the things that I like to talk to realtors about is that we have a duty, right? And we talk about the fiduciary duty that we have to our clients, but the duty to the Fair Housing Act supersedes that, right? And it is our responsibility to make sure that we are consistently adhering to the Fair Housing Act in everything that we do. So with that, I definitely want to leave some time because I'm sure there's going to be some questions for me as it pertains to this. But I know we do have a couple of examples. So if we can go to the next slide, which is one example. So Michelle is a veteran of the United States Navy and is seeking to purchase a home in Maryland using Veterans Administration funding, better known as VA. She finds a home she likes and contacts the listing agent. The agent tells her that he and his clients are not interested in buyers using VA loans because of the stringent property condition and or appraisal requirements, and suggests she seeks traditional financing. This is potentially a case of source of income discrimination. And you always hear me preference potentially, right? Because, nothing is always black and white. And I'm sure Kathleen, being the great attorney that she is, can fully understand and appreciate that, right? So, but we do want to make sure, again, that when we are taking a look at things and we are communicating to potential buyers, that we are letting everyone who is able to apply or submit a contract for a particular property, we give them the opportunity to do so. And if we're not, that we have a legitimate business reason not to do so, and that reason is disclosed. And we could talk about that a little later as well. We can move on to the next example for me, Kathleen. Matthias is advertising a home for sale in Riverdale. In the listing comments, he states that the seller is only accepting offers for cash or conventional. Again, this opens up some liability to be potentially discriminatory based on source of income as well. And I will be honest, folks, I see this a lot still in the MLS, right? And don't be afraid, I'm not calling anybody out, right? But I do kind of wear multiple hats. So my role as a realtor and my role as a deputy director on the Maryland Commission on Civil Rights is to highlight and point out where we are still falling short. So normally I'll see some things or I'll hear what's kind of happening within our industry. I do kind of reach out to Kathleen and say, hey, Kathleen, this is kind of what I'm seeing, right? We need to make sure that we are training folks and communicating this to all of our realtors to make sure that we're fixing it. Moving forward, the Maryland Commission on Civil Rights will be filing complaints directly against agents who are putting these things up on the MLS. So recognize that we don't necessarily need a complaint to come forward. We don't need an actual person to come forward and say, hey, I believe I was discriminated based off of source of income. If we see it and we observe it, we do reserve the right to file a complaint on behalf of the Maryland Commission on Civil Rights in reference to this. So just know that we are taking a closer look at it. HUD is taking a closer look at it. And what you'll begin to see more of is those agency-initiated complaints against agents and brokers in reference to how we are updating MLS and the notes that we're putting in MLS if we believe that it's a violation of the Fair Housing Act. But with that, I will pass the baton.
Actually, I was going to say, can I ask one question, Cleveland? Because specifically about MLS, a question that we've been asked. I think if you're putting a listing on MLS, you can check the loan types that the seller is willing to consider. I think so, not just in the agent remarks, but if someone is just checking, conventional or cash, and indicating that the seller will not accept VA or FHA, I assume that would be considered a violation as well.
Absolutely, unless there's a reason for it, and that reason is disclosed, right?
Okay.
So there are certain properties that simply won't qualify for FHA or VA potentially, right? Whether it's because of property condition or, some condominiums aren't approved potentially. In certain situations, we will allow it as long as the reason is disclosed, not just this blanket, we're not taking FHA and VA. A lot of times in conversations that I've had with agents around, why are you just taking cash in the conventional? It kind of goes back to the traditional, well, we don't want to deal with that particular process, right? That's a no-no, right? As well as what we tell people is that if you're saying that you believe it won't pass the inspection piece, well, technically you might not be you're not the home inspector or the appraiser, right? So you may be making a conclusion that may not be true. I think that we've all been in situations as licensed realtors where we thought something was going to come up on the inspection and it absolutely didn't. Right. So we do have to be very careful about making some of those assumptions that things won't happen unless we have some documented proof that we know it doesn't qualify for certain types of financing.
Right. Okay. Perfect. That's actually a good transition to Michelle's piece. I think Michelle's going to go next. We're going to talk with a little bit more detail about some of the loan types and the processes. You know, if the seller might think, oh, this type of loan is going to be so difficult, it's going to take forever, or maybe USDA. There's certain geographic areas where those loans are not an option. So thanks again, Michelle, for joining us. Do you want to maybe start with FHA loans? Give us a little bit of an overview to help educate, especially listing agents, kind of be able to explain it to their seller clients.
Absolutely. Hello, everybody. Happy Thursday. I could talk lending for hours. And Tom Casper, I've seen your name since I've been in lending for 29 years. So you've always been a great appraiser. I'm going to try not to steal a lot of your stuff, but just say, oh, and Tom's going to talk about this. So for FHA income, well, first of all, I want to say, do not be afraid of government loans. There are so many myths that, you know, agents from 20 years ago or 10 years ago say, oh, that's going to be a nightmare. Not true. I'm going to mention one legislation that happened, or it's not really legislation, but what Fannie and Freddie are doing. Last year, they changed the pricing on second homes because of Airbnb and VRBO. Well, this year it was going to be effective in May, which means lenders price it out a month or 2 months in advance. They pushed it back to August, which means we'll start to see rates affected for conventional loans. So I think the thought is, oh, conventional loans are easier. You're going to get better rates. That's actually not necessarily true. And Fannie and Freddie are going to put more rate pricing add-ons for just debt to income ratio that exceeds a 40% debt to income ratio. So this is coming at a timely time frame here to say we will probably see more government loans, FHA loans. FHA income, there are no income limits. Now, you mentioned settlement expense programs. Let's talk about Maryland Mortgage Program. If there is a grant program with an FHA loan like MMP, and some of the counties have different programs, then yes, there will be income limits. But if it's just an FHA loan, there are not income limits. Okay. And a lot of clients will come to me, or even agents, oh, FHA is only for a first-time home buyer. Absolutely not true, as long as you don't currently have an FHA loan financed, and then there's some parameters to that. And so a buyer can actually own up to 7 other properties and one be the FHA finance. Keyword being, it's going to be their primary property only. Okay. For credit, let's talk about credit. And I lumped in qualifying. Some lenders, including us at Fairway Independent Mortgage, will allow scores down to 580. Now, some agents might be like, oh, that's a marginal buyer. I cannot tell you how many FHA, MVA, and USDA buyers that are actually above 700 where FHA makes sense. By the way, FHA in the last month just lowered their monthly PMI to 0.55. So that's huge, because if you have a credit score that's below 740 on a conventional loan, guess what happens to the rate? The rate goes up every 20 points on a conventional. Guess what happens to the monthly PMI? The monthly PMI factor goes up. And that's why you might see an FHA buyer who's got a 680 score. Some lenders do put overlays where they may want a 600, 620, or 640, or using a Maryland Mortgage Program, they might need a little bit higher score, 640 or 660. So I wanted to mention that. I mentioned the price adjusters of Fannie and Freddie, just like they did on second homes last year. I'm going to give you, I love to give true life stories. So I had a client, FHA, Montgomery County, there were 10 offers, right? And our client wrote over list. They actually even wrote an addendum saying they would pay X dollars over any delta difference of the appraisal, okay? High earner, 300,000, right? But had credit. So they were going to get a better rate by like 0.5% better by using FHA than going conventional. I always send the listing agent, actually a lot of agents will CC me in their offer so I can reach out, being proactive. Hopefully lenders are doing this. And then I send a detailed listing presentation so the listing agent can see that these clients are ready and well qualified. And I think that's the key that as lenders need to be doing, you know, working with the buyer's agent and making sure the listing agent can convey that. Guess what? 1 out of 10 Listing agent really didn't know much about FHA, was totally scared. We got it, but I also do a video on the myths of government loans. And these are the 4 things I'm going to say. Comps are comps. And I know Tom will talk more about that, right? Doesn't matter what type of loan type it is. Repairs, typically it's going to be safety and health related county or city ordinance. Tom's going to talk more about that. But I'm going to tell you, I've had a couple conventional loans, at least a few a year, where a conventional appraisal has stips because of these things that we're talking about. So the mentality or mindset is, oh, if it's conventional, it's going to appraise and there aren't going to be any required repairs. That actually may not be the case. And qualifying ratios, conventional limits it to 50%. Just because a client has a higher ratio than 50% doesn't necessarily make them a not great buyer, as long as the lender is inputting the right income, being conservative. Some of us can even submit it to underwriting to get that pre-approval before they even go on the street. Many of my FHAs might even be a 50 to a 56.9. And guess what? They've happily closed. There's also a misconception with the credit and qualifying that FHA loans are going to take a long time. If you add a layer like MMP or a DPA, then yes, I would factor at least 30 to 45 days. But a standard FHA, conventional, we're going to close those loans on average in about 15 days, okay? The key is, and a good lender should tell you this, do you have approved eligible findings? And most of us lenders can run the loans through either Fannie Mae system DU or Freddie Mac system LP, okay? So I think I mentioned the credit and qualifying. Let's talk about down payment. So FHA is only 3.5% down, whether you bought your first house or you're buying your next move-up house. The seller can pay up to 6% of seller help. I know some of you be like, Michelle, seller help in this market. I am seeing it, and we know it's not going to be the coming soon. It's not going to be, it's only a few days on market and all offers are due by, right? I will say also, don't be afraid if we're using FHA with Chenoa, which is another down payment assistance program. The pro of that is you can have a non-occupant cosigner, especially with our young earners or our clients who've maybe gone through a divorce or something like that, or we can't document child support income to help them. Maybe 30-day closing, but also another great reason is they have to occupy and live in it for 12 months. Unlike MMP, where you always have to occupy it, okay? And FHA loans are assumable. So that also helps get that buyer into that house where rates are now. And if they went up, they can assume their own mortgage without having to refinance to a higher rate. So FHA loans have that awesome feature. Geographic limits, there are none, okay? Allowable properties, Cleveland touched on this as well. Condos, condo townhomes, townhome PUDs, single families, no co-ops though. And one thing about condos, absolutely right, is some may not be FHA approved, some may not be conventional approved, but I would really rely on the lender to check that out. Like I just got a VA contract accepted this weekend, yay. Listing agent was telling me, no, it's not VA. Thank you, Cleveland. And they're like, no, it's not VA approved. And I'm like, actually it is. Well, in DC, sometimes they put the, I don't know, like the borough or whatever you want to call it. So it said Old City too. Well, guess what? The name of the condo. So if you put the information in right in MLS, the condo project name was called the Josephine. Guess what? It is VA approved. I will say VA's system is a little trickier to find it than FHA's. It was not conventionally approved. So I let that listing agent know that. My buyer's agent's like, what? And they accepted our offer, okay? The loan amounts, the loan limits have gone up. So the DC, Maryland, Montgomery County, PG, Frederick, Charles, Calvert is up to $1,008,930. Well, in this market, to be able to go FHA, especially if you're talking about a 2 to 4 unit, my favorite, especially in DC and Baltimore and other areas, and only put 3.5% down if it's a primary, huge win, right? Especially with closing costs and prepaids being, you know, we're a high cost area. In the Baltimore area, Anne Arundel, Baltimore, Carroll, Howard, Hartford, Queen Anne's, Eastern Shore is going to be 726.2 with only 3.5% down. Condos, we talked about this. They must be FHA approved, and lenders are always going to do a lender condo questionnaire. So when they put something like no FHA financing, they may have knowledge that the condo delinquencies are exceeding that 15% level, or that there's a higher investor concentration. But I am going to give you this. Lenders of a condo team, I had one that was FHA. The owner concentration was, less than the 50%. Well, we were able to make an exception because the delinquencies were like 5%. We still close that loan FHA. So always check with the lender who's doing that loan. And if they say no, have a second backup lender to validate that. Okay. HOAs, just so you know, lenders don't really validate anything with a PUD. We're just going to look for the docs in the title work. Appraisal solutions, comps are comps. I'm going to mention that. All good buyers agents are going to provide that. Listing agents too. Always meet your appraisers. I'm sure Tom's going to talk about that. And one solution I have, if the house is in great shape, we don't need to probably worry about lender required repairs unless Tom tells us something that we need to be worried about. But as a backup, think renovation loans. They can take maybe 30 to 45 days. I've done them way faster. The key is making sure we have a 2-3K consultant who meets with the property in lieu of the home inspector. So we already have that ready to go if we're worried that there could be a significant repair list. Okay. And the streamline under 29.5-ish, no structural work, over 29.5 structural work, that takes care of worrying about any lender required repairs. I'm going to mention something on FHA. FHA flipped the rule back on flips. So remember, if you've got an investor who bought that property, remember that any FHA buyers coming 90 days and the contract written on 91 days. And the second appraisal up until 180 days, if the second appraisal is required, the seller must pay it. Okay. So I threw a lot at you and hopefully under 10 minutes or less. USDA is going to be a little bit faster. USDA, there are income limits. And then if you combine it with MMP or a different program, those income limits might be different. So again, that's where the lender should be instrumental in saying, hey, I've done and vetted all of this before the client even went on the street. It's funny, I got a call from an agent a few weeks ago. Hey, my client's going to go look at a USDA, but it needs a lot of repairs. I'm like, great, we have USDA renovation. And so I said, but do me a favor, just send me your MLS link so I can look it up. I know you said it's USDA, eligible. Guess what? The property wasn't in a USDA area. So I'm going to take out that geographical area. They're very specific on their maps. A lot of our Baltimore area are not USDA eligible, but then let's say you go out to Carroll, outside of Westminster, outside of Eldersburg, or really north up towards the PA line, Eastern Shore, or outside of Frederick per se, maybe like Hagerstown or Thurmont or something like that. Okay. In most areas, the income limits is 129.4, but it also goes by family size. So like MMP does 1 or 2 or 3 or 4. This one is actually 1 person, 2 person, 3 person, up to 7 or 8 people. Okay. They do not have to be a first-time home buyer, but it is income limit driven. I'm going to say the biggest, toughest thing about USDA, lenders are looking for a little bit higher ratio. We're looking for a 620 score. Some lenders may even want a 640 score. Some of us will allow manufactured homes, but the ratios are 29:41 unless you have some caveats, exceptions, like the payment shock isn't huge, that maybe there's some reserves, maybe it's a 680 score on some of those. And a lot of times your USDA buyer might be a 660 or below. No non-occupant cosigners on that. And I would say on average factor at least 30 days. Lenders have turn times of, because not only is the lender reviewing it, but then it has to go to USDA like an MMP will. So I always say that adds at least 10 or 15 days when you add layers to it. And USDA uses a very picky system called GUS. It is a lot pickier, okay? Down payment 0 though. It's kind of like a VA loan, so no down payment. It's like an FHA loan, but cheaper in the fact that there's only 1% upfront versus 1.75. And the monthly PMI is even cheaper at 0.35 versus 0.55. Acts like an FHA loan, where the seller in theory could pay up to 6% towards closing costs and prepaids, okay? I mentioned it's rural areas. I mentioned the lender should help you look it up, send them the MLS link so we, have all the information. And is there any wild cards? USDA, we're one of the few that do offer USDA renovation loans. So if it were a property that had some significant issues, then think a USDA renovation, okay? And again, property primary only, okay? And VA, near and dear to my heart. My dad, my brother, my uncles, my grandfather was a tail gunner in World War II. Love helping our military families. They fight for us and our freedom. So I hope that we are not, excluding any of our VA buyers. There are no income limits unless, again, you use it with MMP or some other program, okay? VA credit and qualifying. Again, we'll go as low as 580 credit scores. Some lenders may put in credit overlays for their level of risk. Now, a lot of times, in fact, I just had a client call last night. A lot of people think, oh, well, they own a home, so that's probably VA. So they're not eligible to use this again. Well, first of all, a lender should always get the current VA certificate of eligibility, what we call a COE, okay? I just earned a client's business, Veterans United. We'll just pick on them real quick. Guess what their letter said? It was 4 pages long, by the way, but it said, pending VA certificate of eligibility. Is that going to give a listing agent warm and fuzzies to accept that offer? No. And this client, I'm glad he sent it over to me because even though his loan was paid off, VA isn't always the fastest to restore the eligibility. So I'm going to need to help them with that. And the client that went under contract last weekend, he had refinanced from VA to conventional a few years ago. And literally in 1 week, and I'm not making that promise with VA because VA can take 2 to 4 weeks, but this one happened to be, he got me the info, we uploaded to the VA portal, and we got a 1 week VA restoration so he can use VA again on his new house. And VA, like this particular client, was putting down a down payment. And the VA funding fees actually just dropped too a little bit. So he's only paying 1 1/4 and no monthly PMI, which is huge. VA does it best. How they qualify a client is net income, less what the square footage is of a house. Let's factor in a little bit of percentage of maintenance and utilities. That's why I always want to know the square footage of the house on a VA. What's all said and done to pay the bills, right? To eat, to pay utilities, so you have light and internet, right? And it's based off of how many family live in the house. Just recently, I closed a client, not contingent. They had a VA home. They were buying a new VA home. Their debt to income ratio is a 61. So VA says 41. If you meet 120% of that VA residual and we get an approved eligible, guess what? That's an awesome buyer and seller for you. So do not discount them. Make sure you're working with a lender who knows VA. And VA's rates right now, and in probably over the years in history, have always been about 1/2 to 3/4 better in rate than a conventional, even with marginal credit. FHA and VA are flexible and are nicer on rates than conventional, okay? And I will say the last 3 or 5 VA buyers I've had in last month all have 700 or 800 credit scores. They are not marginal buyers, okay? And again, we run VA loans just like FHA loans through automated underwriting. Fannie Mae's DU system, LPs, Freddie Mac sometimes give us less documentation, which, yes, as a lender, I'm all about trying to streamline that documentation. And on average, I'd say write a 30-day contract for a VA, but oftentimes we're selling them in about 3 weeks. VA does have turn times per state, and on average, they have about 10 days to go out and inspect the property. But I've had them sometimes go out in week 1. So don't think it's going to take 45 days. Now, if it's USAA, Navy Fed, yes, it's going to take all of 45 days, right? Geographic limits, there are none. And down payment is 0. And a lot of times, if I'd probably say out of every 10 buyers that I'm working with at our VA, probably 3 or 4 have some kind of disability. And then they're exempt from the VA funding fee, which is a huge win to go VA over conventional. The seller, this is a big misconception. And how USAA and Navy Fed view it is not actually VA guidelines. The seller is allowed to pay all closing costs, all of those one-time costs. Let's just say that's 3.5%. In addition, the seller can pay up to 4% towards prepaids, which means taxes, HOA dues, condo dues, homeowners insurance, per diem interest. And yes, I've even had a seller pay debt. That's part of the 4% of the sales price to sometimes help a client qualify. Allowable properties, same as FHA, no co-ops, of course. And the loan limits, again, you can go above $1 million in finance. I just settled a client. He's high-level government, bought and built in Virginia. His price tag was over 1.3, and he did put about 100,000 down with the builder. But guess what? He was able to finance over 1.2 million, no monthly PMI, and a fabulous rate. Okay, so don't discount our VA eligibility. Condos, there is a VA site. It is a little tricky. So if you're not finding it, don't assume it's not VA approved. Have your lender double check and look it up. And I'm always about solutions, which is why I call myself the Lone Ranger, which is VA renovations. We have an option to go up to 50K. So again, that can take that repair issues off the table by having that as a backup to switch to that loan. If the STIP list were huge, utilities aren't on, et cetera, which again, not trying to steal any of Tom's thunder. And I'm sure I just gave him a whole bunch more ideas of what to talk about. A couple things on VA that you must know as a listing agent, buyer's agent. The seller must pay the termite. Okay. 2, the realtor admin fee cannot be charged to the buyer. That's it. I think I covered all the bullet point topics that you wanted. And of course, it's a primary residence only, right? Did I cover everything, Kathleen?
I think you did. The only thing I think the seller does not have to pay the termite anymore. I think VA just changed that. I'll double check that.
Double check that. I haven't seen that yet, but they've been making some recent changes, which is unusual.
Right. I will say the one thing that kind of stuck out with me is that, there's a saying that, perception is reality. And I think listening to you speak, I think it's the exact opposite. There are a lot of perceptions or misconceptions, and the reality is far different. And I think that's kind of what we're trying to accomplish today, is to help people understand that the perception that, these VA buyers may not be qualified, may not, may have lower income, may have whatever. It's not always true. So perception is not always reality. And I think that's great information for people to have. Reach out to the lender and verify information, find out if there's a workaround, or if maybe, there's a loophole that you don't know about, But again, I think that's kind of key, that the perception or the myth, the stereotype may not be reality. And I think that's a good transition to you, Tom, talking about sort of perceptions and reality. I think, talking about this, where the loan type is considered source of income, one of the first questions that were asked is, well, what about, there's some properties that aren't going to qualify for a VA loan or for an FHA loan because of something about, some item about the property. And I think, again, talking about perceptions, I think sometimes the perception is that the lender is going to ask for all these repairs if it's a VA loan. And Michelle just touched on just briefly, if it's a new home or a home that's in good condition, that's not even true at all. So do you want to maybe start with FHA and maybe give us an idea of the appraisal process, just an overview of it, and then more detailed information on some of the minimum property requirements for the various loan types?
Sure. Thanks for having me. As an appraiser, we don't get to talk to people a whole lot anymore. So Michelle covered a lot of information there. Basically the lender takes all responsibility for ordering the FHA and USDA appraisals now. They're direct endorsement underwriters, and VA still orders them through their system in Roanoke. We don't have a local Baltimore or DC office for any of them. Philadelphia's for FHA and Roanoke's for VA. But the VA approves appraisers a little differently. You used to have to be your address or your office address had to be in the county that you were approved. They kind of opened that up some years ago. but I'm approved here in the county of Carroll County. I live there, so I'm still approved there, but I can get approved for other counties in Maryland. And their underwriters or SAR, staff appraiser reviewers, are through the lenders now also. Gone are the days of mailing the appraisal down to Baltimore for VA to review it, and then they would mail it to the lenders. Everything gets sent to the VA system, to their portal, and the lender is able to retrieve the appraisal. So basically, the other items are, as far as agents would be concerned, would be reconsiderations of value. That would go through, for FHA, would go through the direct endorsement underwriter, would have to be approached. VA, we do have a system. I don't know how widely known it is. It's a Tidewater policy. If I am going to come in lower than the contract price on an appraisal, I would have to contact the point of contact with the lender that ordered the appraisal and let them know that I'm requiring any additional information on the property. And then they have 24 hours to get any information back to me. So there is a process there that would help any low appraisals. The only problem with the process is I stop work on the appraisal. I notify the point of contact. They would then ask the agents for any additional information. Is that they don't have a copy of my appraisal because it hasn't been finished yet. So they don't know exactly what I have considered. So they would have to just kind of throw out all kind of information. Then I have 24 hours to get back and I guess would have to decide which comparables, if there were additional comparables used or supplied, and why I used them or did not use them. So they do have a process in place if you do have value issues. I guess the main part, Michelle touched on geographic limitations. And again, it's just USDA, what areas are eligible, and they have a map available. But that usually is all done before it gets to me. If it's not eligible, then they probably wouldn't send me a USDA appraisal. The main, as far as minimum property requirements, it's safe, sound, and sanitary. And that's all the government loans. USDA pretty much goes with FHA. In fact, on a USDA appraisal, we have to write on there that it conforms to the USDA, to FHA minimum property requirements in the HUD handbook. So they're pretty much the same. They did used to have, USDA used to have some quirky guidelines. I'm sure some of you remember that they would not, property with an in-ground pool was ineligible for a loan for USDA. Then they made it that they were eligible, but were given no value. And now it's just like the other loans. So there's some quirky things with each one, but nothing major. But it's all safe, sound, and sanitary. Michelle had stated earlier with conventional loans. I've had conventional underwriters and investors that have, if there's something seriously wrong with the property, a safety issue, they want them repaired also. If they don't have a functional kitchen, functional baths, they want them functional. So it's not just the government loans. The conventional loans also will require these major issues to be resolved. The minimum property requirements, just kind of go over, I listed some down here. The major ones that come up, or lead paint. Any property that's constructed prior to 1978 that has peeling paint anywhere on the property, fence posts, mailboxes, that is to be remedied, scraped, and painted. After 1978, it would only be called for if it was in an area that could lead to further damage, maybe a fascia or soffit that would lead to leaking down the road, then we'd want to take care of it. But prior to 1978, anywhere on the property, it's peeling, would have to be taken care of. So that seems to be the biggest requirement that comes up on older homes.
Hey, Tom, can I interrupt just for a second? Is that for all the different loans? Would that be conventional USDA, VA? I mean, I'm assuming lead paint would be
That's
a
all.
deal breaker, a problem for every type of loan, correct?
That's all the loans.
Okay.
Yeah, and that's the biggest difference probably is between that and conventional is the painting, and we have that come up a lot as far as agents or loan officers asking us about a property that may qualify or not. But you know, it's not that bad. And I do a lot of rural properties out here, and you have barns, and a lot of them are stained, and it's just weathered. They don't have to be taken care of. It's not peeling paint. It's just a faded stain, and it's barn wood, and barn wood is weathered and it's made to last that way. So the next one was handrails. FHA, USDA, it kind of taken that away, and it's our judgment call. If it happens to be 8 or 9 risers with no rails on each side going down into a basement, then it's a safety issue. We'd call for it. It's no, it becomes the appraiser's opinion. And now VA, their guidelines are if it's over 2 risers, they want a handrail. Now, they also, though, go with whatever local jurisdictions rules are, building codes. So here in Carroll County, it's over 3 risers. So generally, I just write on the appraisal that it's 3 risers, and in the local jurisdiction of Carroll County, it's meets local building codes, and then they let it go. I come across a lot of area ways, and you kind of take it case by case. You can have an area way, it may be the only egress from a basement. And then that would probably need a handrail. The top of the areaway wall, if it's level with the ground and you have an 8-foot drop that a child could run, fall 8 feet on their head, then I call for a safety rail. But it's each case that would come up. But generally, it's if it's over 30 inches high on a porch, you need a safety rail. Other than that, yeah, I think that's pretty self-explanatory. Utilities, FHA, USDA want us to test the utilities, make sure everything's on. Heat, air conditioning, if it's not cold, some electrical plugs, flush the toilets, water pressure, hot water, appliances, everything. They want to have all those items checked. VA does not require utilities to be on. If we see something that looks a little out of the ordinary, we could call for it, but otherwise we'd make the assumption that everything looks operable and they'd go with that. So that's the difference between VA and FHA on utilities. Let me see. Michelle might know more than this on private roads. FHA has done away with the private maintenance agreements. VA they still require, the property to have an easement for ingress egress, and VA does want a written agreement, and if not, I believe they would want the owners on the private road to sign an agreement that they all maintain the road. We're just supposed to comment really on the condition of the private road. Permanent heat sources, it's are required, and that would be required for conventional loans also. But you have to keep areas with plumbing can maintain a temperature of 50 degrees. Now that's VA. Now FHA seems to have changed a little of that, and that would be USDA also, is they're saying that if you have a bedroom and you close the door and it has no heat, then they want to have heat in the room. So I've talked to them in Philadelphia, and that's the way they want to handle things now. So for years, we just were concerned about bathrooms and kitchens or any areas that had plumbing, laundry rooms, would have to have a permanent heat source. Windows, FHA, USDA wants the windows to open and stay open on their own. They consider it a safety hazard if they don't stay open on their own. I have a smashed finger here. I don't know if you can see it, that I had a property recently that I unlocked the window and it fell down on my finger. So that's probably why they consider it a safety hazard if you need to get out. Now, it's only one window in a bedroom that would have to do that. The other windows, what I usually do is check and then call that deferred maintenance. So you need at least one window out of a bedroom that the window would open and stay open. VA doesn't require that. They say if you need to get out because of an emergency, a fire, you'll throw a chair through the window. So that's a difference between the two there. It's just, I don't know how the rules are a little different on each one, but they are. I don't require, if there's a window in a dining room or a kitchen or a living room that's next to a door, I don't require that for any of the FHAs, USDA to open and stay open, because if there's an emergency, someone's going to go out the door right next to the window. So I would call that deferred maintenance. It would kind of be put in the cosmetic category, and in evaluation of the condition of the property would be adjusted there. Let me see. Well and septic. VA, we just have to check to make sure everything looks okay. You have water pressure. Septic systems are, look like they're functional. You flush the toilets, you walk around the yard, you're not sinking in around the septic tank. The FHA, we do have, we're required to put distances on the appraisals. It has to be over 10 feet. The well has to be over 10 feet from the property line. The well has to be at least 50 feet from the septic tank, and the well has to be over 100 feet from the absorption field. Sometimes we can't determine exactly where the absorption field is, so we might have to get a copy of the plat, or with the health department, they can help us out, and we're okay.
I think we're getting close toward the end here.
Okay, I'm sorry.
No, that's okay. We have that was actually really helpful. And again, this is just me just taking in what you're saying. I think again, the perception that a lot of people have is not really consistent with what you just said. Some of the sort of big ticket items or the more problematic items, the VA loan would require that they be repaired, but it would be an issue for a conventional loan as well. So
exactly.
I think that's good information for everybody to keep in mind. What your belief is, or what your initial reaction may not be accurate, or it may be the same regardless of the type of loan. So I think that's good for everybody to keep in mind. And also, talk to your lender and get a little more information if you're not clear. I think what we wanted to do to finish is to kind of just touch briefly on some best practices. And again, anybody could really chime in on these. Cleveland, you might be a good one for these since you're a realtor and you're, loading listings on Bright MLS as well. But I think the first point up here, I think, is the key. And I hope that people picked up some good information today. I think one of the main points here is to educate your client, especially some of the information that Michelle was giving. VA buyers, FHA buyers, they may have very good credit scores. They may have great financial resources, maybe buying a property that's, $1 million plus. So some of the myths or the perceptions that we have are just not reality. So again, that's a good thing to understand, a good thing to be able to communicate to your sellers, if you're a listing client. The financing options, I think Michelle did a great job of that. Appraisal and lender required repairs, I think that's good. Understanding the minimum property requirements, I think, again, Tom, you did a good job of that. And it sounds like there's some differences between the loan types. I think the key, though, is probably the next one. And Cleveland, you could chime in on this. I think there are some, legitimate issues where something may not qualify for one type of loan. A lot of times it is a perception, but let's assume it is a legitimate issue. I don't know. Whatever it might be, there's some problem where it's not going to qualify for a certain loan type. What would be the best way for a listing agent to communicate that information in a not a discriminatory way, but a fact-based way?
One of the best ways is to think about, whether we put that on a disclosure form, right, or disclaimer form, right, to indicate what that particular issue is. So part of the issues that we see at our agency it's not that that in certain situations these things aren't real. It's just not that we didn't communicate that that particular issue with the property to everyone, right? So if you're saying that the property has an issue that is going to disqualify it from any of the government-backed loans, it is best to disclose that so everyone knows that, so that you're not just saying, hey, no FHA, no VA, no USDA. You are clear about why that particular property is disqualified from those loans, which gives it a legitimate business reason as to why your client isn't accepting contracts based off of those types of loans.
Right. And I know sometimes this question, I think, came up at our regional roundtable, or someone had asked me afterwards. I mean, not all sellers, of course, are required to provide a disclosure disclaimer. It could be an estate or a trustee. And again, I think just another thing for people to keep in mind, of course, as licensees, we all are obligated to disclose material facts, right?
Yep.
So if there is some significant property issue, the licensee, the listing agent, can also disclose that. If you contact the legal hotline, we'll often tell people, typically what happens is after the first buyer walks, they do a home inspection. There's something they don't like, they terminate, they walk. Now the listing agent and the seller have information about these property condition, these items or these issues. And what we would recommend, if you contact the legal hotline, we would recommend, the listing agent, obviously you have to disclose material facts. We recommend that you would do so in writing, put it on, letterhead, your company letterhead, team end company letterhead, whatever. And you can upload that to Bright MLS as well, right behind the disclosure disclaimer. And that would be a great way of communicating and sharing that specific information about specific property conditions. Again, you would describe the property. You wouldn't be saying no VA or not, no FHA buyers. You would describe the specific property issues or the conditions that you believe would make it ineligible for that financing.
And that's a good point too, Kathleen. And everyone needs to also understand from a process standpoint, when we receive complaints, and if we issue a probable cause determination against you, that immediately goes also over to the Maryland Real Estate Commission, right? So not only are you going to have to deal with the liability through our agency, once we issue a probable cause finding, it is forwarded over to the Maryland Real Estate Commission for their investigation as well, and for them to also provide some level of remedy in reference to the issues at hand that we uncovered through our investigation. So individuals need to also understand that too, that if you find yourself in that situation, it's just not the Maryland Commission on Civil Rights. We probably have the biggest hammer, but you also have the issue of dealing with the Maryland Real Estate Commission once we're done as well.
Right, okay. All right, thanks. And I think we kind of have touched understanding how to disclose material facts. We touched on that a little bit. Advertising, again, of course, advertising, source of income as a protected class. You are not going to have any ads. You're not going to say no VA buyers, no FHA, whatever. in any type of advertising. You are not going to say no vouchers. You are not going to say the property is not participating in the program. I guess Cleveland, can you give us a 60-second overview of the voucher problems with vouchers and what type of things you're seeing at the commission?
Absolutely. 60 seconds. Before we used to see it was simple. People would say no vouchers, right? Not accepting vouchers, no Section 8. That is no longer legal. So you want to make sure that as you're putting these things up on MLS, you're not saying that because that is a violation of the source of income statute as written currently. Also what we're beginning to see is people are kind of, we get it, people are slick, right? So instead of saying the no Section 8, no vouchers, people are now saying not registered for voucher programs, right? That is also a violation of the source of income statute because we know that that is used to deter voucher holders from applying for rental to property. So you really want to stay away from any language regarding voucher holders, any registration, any of that, because anything that we perceive as a direct deterrent for voucher holders is going to be deemed a violation of the source of income statute. So, and that is exactly what we're seeing now, is that individuals are trying to find a way around saying no Section 8, no voucher holders, and trying to be creative in reference to the language. But I would just, again, remind everyone to be very careful of that. We do have some cases that we are issuing probable cause against agents in reference to doing that because, again, it is a violation of the source of income statute.
All right. That sounds good. I think that is it. We were out of time. This last slide here is not CE. You all can do a screenshot or take a picture of that if you want. If you want to reach out to any of our panelists, you are certainly welcome to do so. And I want to thank everybody. Thank you, Tom, Michelle, and Cleveland for joining us today. Dan, how are we time-wise? Are we done?
There were a few questions, Kathleen.
Okay.
There are questions. There are several questions. We have a couple ways you can do this. People will start leaving this webinar because they have things to do. I don't know if you want to answer these and we can send them out.
I could, and I think we could do a couple of these very briefly.
Okay.
Will Bright be removing acceptable financing? I'm not part of Bright, but my guess would be no, because Bright services a lot of different jurisdictions and different jurisdictions have different definitions of source of income. So I guess we could follow up with Bright on that, but my guess on that would be no. Because source of income, I think, is defined differently in Pennsylvania than it is in Maryland and differently in some other jurisdictions. So I don't think they'll be taking care of that. Can the lender provide her information? Yes, it's on the screen now. Thank you so much. Thank you. You can also use, does USDA require the property to be held in title for 90 days? Yeah, do they have a seasoning requirement as well, USDA?
So FHA is the only one that has a flip rule, guys, where you cannot write the contract on the 91st day and you can't write a contract and then order the FHA case number, whatnot. USDA, conventional, and VA do not, but I know Tom's going to love what I'm going to say. As a listing agent representing the seller, you absolutely should have a list of the renovations you did. And if you can back it up with invoices, Tom is going to love you more. Any appraiser is, because lenders still look at what did they buy it for and what are they trying to sell it for to make sure that it's not an artificial, flipping, so to speak. So, and a lender still could require a second appraisal if they don't like the data they see. So make it easy on the appraiser, provide that information. And if it's an LLC, make sure that the title company and the lender have that so that the way the appraiser has it. So I answered that question, I think.
Okay. And then VA, again, we just did touch on that briefly. VA changed the rules. The buyer can pay for the termite inspection. That was changed last year. If a borrower needs a co-signer or co-borrower on FHA, if the co-signer, this is a good question. If a borrower needs a co-signer or co-borrower for an FHA loan, if the co-signer or co-borrower already has an FHA on their primary residence, could they also be the co-signer for the other person's loan?
That's a really good one, and I've had that. So two parts to this. One, let's say they've co-signed, in this case, on an FHA. All we need is 12 months payments showing, let's say it's the brother, right, that they co-signed for. We need to show the brother's in first lien, meaning he's the first note holder, and that our co-buyer was the non-occupant co-signer. And then 12 months payment showing that the brother's paying the account out of his account, not a joint account with them. And if they want to buy another property, again, the documentation is the key in some of those cases, yes. And not having to count that mortgage payment against them in buying the new house either with co-signing. But the key is the note and the documentation.
Okay, thanks, Michelle. Cleveland, this one's for you. How do you respond when a tenant's agent inquires about a landlord accepting a voucher when you know as a landlord's agent, they do not accept vouchers?
In the relationship with your client immediately. I mean, so I would say this, like that, you don't allow your clients to force you into violating the fair housing law, right? So the key is, and on a serious tip, is to educate your client in reference to that being a violation of source of income, and that they have no choice to accept vouchers if that's all they have, right? Now, again, we're not in the business of telling people who to rent to, but we are saying that, again, having a client that's telling you that they're not going to accept vouchers, you need to be able to explain to them that that is a violation of the Fair Housing Act, a violation of source of income, and that is something that they would not be able to do.
Right. And there were a couple questions on that. I think, again, Cleveland, as you know, we're in both of your hats. You're well aware of this. There was another one, too. Those statements still exist in MLS. There's management companies that say landlord doesn't want Section 8. What about stating a minimum credit score the landlord will accept? That is acceptable, right? That was in the statute. I think a landlord can use commercially reasonable methods to, I think the credit score is acceptable.
It absolutely is. And we don't tell people they can't have criteria. Only thing we say is that your criteria has to be used consistently. And in reference to that, I think the biggest thing that we see, and I apologize, I forgot to mention it, really is how people are applying these income requirements, right? So from a rental standpoint, so if you have a person that's renting your property, and let's say your income requirement is that they must have 3 times the rent to rent the property, right? If a person has a voucher and the rent is $1,500, and let's say the voucher is for $1,300, their rent is only $200. So the 3 times the income piece is only applied to the 200. So it's $600, right? Not $4,500. So people need to be very careful about how you're applying the income standards, because again, when someone has a voucher, you don't apply the entire thing to them. You only apply the portion that is required for them to pay, not the entire thing. If you apply the whole thing and you deny them as a result of that, you have also violated the source of income statute.
Right. There was another question kind of along those lines. What happens if your client rejects a voucher holder? And again, just as Cleveland just pointed out, just because someone's using a voucher, it doesn't mean the landlord automatically has to accept them. But the landlord can't automatically reject them. The landlord can have criteria. They can have a minimum credit score. They can have whatever criteria they need to have. That criteria, if you're representing the landlord, you establish that criteria on day one and you apply that criteria across the board. Cleveland just explained the income one very well. A lot of the people who get in trouble, it's because they have a voucher, a person who's going to be using a voucher who is, otherwise well qualified, and then the landlord comes up with some other thing they want to check, and then it's a pretext, right? If the landlord doesn't verify or doesn't check with everyone's current landlord to verify their, what would the landlord rent to them again, all of a sudden they've got a voucher holder who has good credit and satisfies the other criteria. All of a sudden I want to start checking with this person's current landlord. That's a problem. That looks like a pretext as a reason to reject somebody who's using a voucher. So criteria is okay. Criteria has to be consistent. Criteria should be established from day one, and it should be across the board. You can't have different criteria for someone using a voucher than for someone who's not using a voucher. Absolutely. I think that's about it.
Hey, Kathleen, can I bring up one thing that Tom brought up in value reconsiderations that I think is really important for listing agents and buyer's agents, especially on VA, which Tom is an awesome appraiser. I've loved working with him over the years. Whether it's FHA or VA, don't assume that the value is not going to come up, but the data you provide is important. So when we get permission to forward over that appraisal to the listing agent and the buyer's agent, look at what comps the appraisers use. Don't send us the same comps because we can't use those. 2, we need them in a PDF version. Okay, so we'll need them in a PDF version. We need at least 3, and we need the reasons why you feel those are better. I had 2 VA in 1 month, just a few months ago. They both came in a little under. We actually filled out the grid. There's a grid for VA. The process is about 3 to 7 business days once we, get it over to the appraisal department to get it over the VA appraiser. And guess what? We won and got the values up. Maybe not to where the listing agent wanted. It was enough to make the transaction work. Same with FHA. So make sure to get that information that first 24, 48 hours. And VA does have timelines, which I think Tom can expand on.
Okay. All right. Are we good? Dan,
I would say, Kathleen, there were 2 additional questions that I just want to touch real briefly. I just saw pop up in the chat. One about whether the landlord is not registered for the voucher program. Most landlords won't be ahead of time, right? Most landlords, you don't pre-register, right? You don't register until you come across a tenant who has a voucher, and then you fill out the RFTA and you go through the process. So by saying you're not registered for the voucher program, 95% of landlords are not. So that's not an excuse not to accept vouchers or to deny voucher holders from renting your particular property. So we want people to understand that too. That is part of the process. Can a landlord reject an applicant because of criminal background? As of right now, yes. We know that there was some legislation trying to get passed this year to protect criminal records. I don't see it moving forward this year, but I do anticipate within the next 3 years or so that criminal records will also be protected from a fair housing standpoint as well.
NAR has some good guidance on the use of criminal history for tenant screening. If you just search on NAR's website, you'll see it. Again, you should be looking at convictions alone, not just arrest, but go to NAR's website. They've got a nice, it's a 2-column thing, do's and don'ts, really easy to understand. And again, something you should share with your client to help them understand as well. I think that is it.
All righty. Well, this has been a very information-packed hour, the power hour. And for all these in attendance still, everyone asks, and yes, we will be sending the slide deck along with the recording of this webinar to all registrants, even those who couldn't show up today. And we've had some who say, can we get this recording? And the answer is yes, you can get this recording. We'll email it to you. Thank you very much. Thank you for this wonderful panel, Tom Casper, Michelle, the Lone Ranger. I'm never forget that. Cleveland Horton, and of course, Kathleen D'Artez. We all appreciate this, and thank you for enlightening us on source of income. And thank you all for attending. Have a great day. Bye now.
Thank you all.
Thanks, everyone.
Bye-bye.
Bye. Thank you.